Okay, so I'm Brandon. I'm founder of the Real Estate CPA. I have a tax background and a consulting background at the Big Four and Ernst & Young. Started the firm when back in 2015, but didn't fully jump into it full time until 2016, and have since built out a pretty good sized firm. We've got 12 employees now, and we're just focused in the real estate niche. Our firm has been moving into a higher level client base. So we've been servicing these syndicates, the folks that are purchasing the 200, 300, 400 unit buildings. We've also started to see a big influx of private equity firms coming into our client base. We've been providing them a lot of accounting and CFO services. And Ron, I'm going to let him introduce himself in a second. He and I have been connecting just over business, just kind of sharing business problems and everything. He's also focused in real estate, and we share a lot of the same problems and solutions. And we had this idea of doing this joint webinar where we kind of walk through what does it look like to go from acquisition stage to operations to sale from a tax and legal perspective. I almost said attorney, but I guess that wouldn't be right. Tax and legal perspective. And we thought it'd be a great idea because we both deal in this space now, and it'd be really cool to just kind of show you guys what we're looking at. That way you guys can ask better questions and kind of know when to pump the brakes, especially in due diligence. So Ron, I'm going to go ahead and turn it over to you. Go ahead and introduce yourself.
All right. Thanks, Brandon. It's a very generous introduction. Like you said, I'm an attorney. I'm based here in Dallas. I'm from Texas. I've been involved in real estate really from the beginning. My parents are both in the mortgage and rental side. Since then, my practice has evolved to cover acquisitions, new construction, investor raising funds, and working out operating agreements and joint ventures between various parties investing together. And so really now I'm with a firm, Palmer Manuel, here in Dallas, about 15 attorneys, and it really, we've been fortunate with the growth in North Texas to really see a lot of deals. And what I tell my clients is, you might be looking at 2 or 3 or 4 offers in a year, or maybe more, but I'm looking at a lot more. So whatever you see in terms of deals, in terms of loan documents, loan terms, standard rates, and different clauses, we see a lot of deals. So I'm here to kind of share that experience with everyone. And as always, open to follow-up questions afterwards.
Perfect. Great introduction. All right, let's jump right into it. I'll let you kind of kick this off, getting to know the investor. And why, and I guess explain to everybody, why does that even matter? Why do we need to get to know our investors?
Right. So the format that Brandon and I were going to follow today is really kind of a hypothetical investor. Let's say we have a client, they're making an acquisition. What do they need to know in a sample process from start to finish? How can they set themselves up for success in terms of tax liability, setting up the right agreements, limiting their legal downside, and really being prepared, what you wish you could have done before you entered into the transaction. And then we'll go all the way through an exit in terms of being a due diligence as a seller and what you're going to look for from the buyer and different contingencies that you want to put in the agreement. So kick off, the first thing that we try to do is get to know the investor. Everybody can give you the cookie cutter contracts or the standard deductions, and they can say that hypothetically this is what you should do. The problem is, every investor, you are unique. And what we try to do is ascertain what the proper level is of how much time, effort, and money we should be spending on your case. And so just to give you an example, if I have a client that is running from family office money, they're buying this property, maybe debt-free, they want to get it at a premium, at a discount, I know that their goals are going to be different than maybe more institutional investor who is raising LP funds. He needs to be built in suspenders on every aspect of the deal because he's using other people's money. He maybe is combining this with debt. And so again, I would say that most of my investors are going to be somewhere in between. You're in between the family office that has a lot of cash to burn and they want a quick close to get a discount on the purchase price. Fine, I understand that and I can provide those services. On the other hand, you can be very conservative. You want to make sure this is going to be a 20-year or a 30-year hold on the property. You want to make sure that every I is dotted and every T is crossed. So what we do is we spend the time up front and not just provide a cookie cutter contract and say, this is what you need. Try to get to know you as an investor and make sure that the legal structure reflects your goals for the next 5-10 years.
Yeah, and that's all imperative, that there's no sort of cookie cutter sort of contracts. I can't tell you how many times, and we don't know law, but we do request operating agreements. And whenever we look through them, you can totally tell if something was from like a LegalZoom or something, and it's just not well thought out. Part of what we do whenever we're helping, or whenever we're on the planning stage, we're not really in acquisition mode yet. We don't have a deal. We don't have an LOI out. Whenever we're in the planning phase, what we're doing with our investors is we're just trying to help them understand what their tax and financial goals are. Does real estate even make sense? Does buying these big projects even make sense? And maybe you're already there. And if you are already there, how do you want to deliver your returns to your investors? Right? Do you want to refinance and keep them all in the property? Do you want to refinance and cash them out? Do you want to hold forever and not refinance at all? Or do you just want to liquidate in totality? 1031 exchange? What are your investor expectations? So we do a lot of work with clients up front, helping them kind of just understand, one, why am I getting into this myself? What am I trying to achieve from a tax and financial perspective? And then two, what am I going to be telling my investors to help sell them on the deal that I'm going to be sharing with them? And how do we need to structure it so that we can maximize those returns, or not necessarily maximize returns, but just meet those investor expectations. That's what we do a lot of in terms of goal setting those return expectations, all that sort of upfront stuff. In terms of operating agreements, so really we don't play a huge role with operating agreements. The only thing that we like to do is just have our investors just kind of think about, and whenever I say investor, by the way, in this sense, I really mean a syndicate. So we're talking about the general partners of the syndication, who are the ones that are buying those 200, 300, 400 unit buildings. And they're saying we need to raise $4 million from private investors, from limited partners. So we're targeting the general partners here with this particular piece, setting up that operating agreement. What we do in this aspect is we're going to look at that. We're going to look at that and ask you, kind of going back to the goals, what are you trying to accomplish? We see a lot of syndicates create two classes of stocks. We'll have a Class A stock, like in your LLC. You can have a Class A share and you can have a Class B share. The Class A share gets profit and loss. The Class B share only gets an equity stake, so it doesn't get to share in the annual profit and losses. But we talk through with our clients while they're structuring the operating agreement to help them understand what those options are, so that they can then go to the attorney and say, hey, this is what I want to do based on what I'm trying to do with this project from a financial perspective and from a tax perspective. So that's really where we come in terms of helping that general partner out and just kind of understanding, how do they want to structure the deal? What's the optimal general partner, limited partner split? You go on Bigger Pockets, they'll tell you 30-70, but is that actually the split that you should apply? I mean, if we're doing like a $10 million deal, we're talking about a lot of money and you don't want to mess that up. So we'll help you with those waterfall models. We'll help you build this stuff out so that you can understand what exactly you're looking at. And we're not like pro investors ourselves, but we just see a ton of it. and we can help point you in the right direction. We can leverage the experience that we've had on other projects, other similar projects, and let you know how they've kind of turned out. And maybe what some of the pushback was, if there were any investors that were looking at that and were like, well, you only have one class of stock. I'm used to two classes of stock, and the general partner is not taking a profit loss split at all. So we can help you just kind of plan for those conversations.
Absolutely. And I think not a common concern, but everybody wants to save money. So the more prepared you can be when you come to your attorney and you have a spreadsheet of this waterfall, you have your initial distribution set out, that saves me a ton of time. I don't have to go through, ask you questions, ask you how the pros and cons of each one. If you've worked through a majority of the tax implications and you just have very specific legal questions for me, again, that's going to save you time. And we spend the majority of our time in the operating agreement. So it's probably directly correlated to the number of investors, but operating agreement is really the meat and potatoes of the LLC. And when you're talking about doing an LPGP structure, you have a limited partnership agreement, you have the LLC operating agreement for the GP. You're going to have interactions between management companies and interrelated parties. So all of these agreements are where we spend our time. So the more you can do with the tax and have that squared away first, it saves me time and it makes the transaction really smoother for everyone involved. I think when you have accounting first and then come to legal, and if I have questions, you can kick back. But for the most part, I'm indifferent. I can draft the agreements to have any type of tax consequence that you guys want. But a lot of people don't have strong opinions.
And Ron, I'd be curious to hear your thoughts on this. So at my firm, we like to kind of quarterback the entire relationship. So we like to pull the attorney in, we like to pull the financial advisor in, or whoever else. Some people don't use financial advisors. That was a bad example, but we like to kind of facilitate it. So we like to take a stab at it before you even talk to an attorney. Are you kind of like that too? Do you guys kind of quarterback the relationships, or do you just partner with the CPA firms?
I think it really just depends on the client. And they're going to look at it and say, is this a deal where my legal exposure or my legal liability in operations is going to be a higher component? Or is my tax exposure and my tax, setting up in that situation, is that going to have more of an impact on my bottom line? And so for a basic multifamily, for something with, low to medium amenities, no restaurants, no retail on the first floor, something like that, they're probably going to go with the tax with you as their quarterback in that situation, because tax is going to be a bigger driver. If they have any type of operating business or an operating component, such as senior living or some compliance on there, or they have a retail mix, you're going to want that legal to kind of quarterback it, because I'm going to set you up with better LLCs and different arrangements. That's more important than your tax implications. So it really just depends on which is going to drive the project, as well as the investor. Maybe they're very, very risk averse and they want the legal to drive the conversation. So
yeah, and that's a great point. We try to stay away from people that have operating businesses in various industries. We do have a couple clients that do it, and the attorneys are definitely quarterbacking the relationship there. And it's just a frank conversation. Say, look, we can save you a ton of money, but that does not, the liability protection for you is way more important than me saving you $50K a year in taxes.
Absolutely.
And clients get that. So yeah, so sometimes we do bow over and say, no, yeah, we need to take that, the better entity structure, the better operating structure, versus optimizing for tax purposes. I don't know if we're about to move on to the acquisition, but one last thing I wanted to just let everybody know. So if you are a syndicate, private equity fund, if you're in a partnership, write this down. Your operating agreements need to designate a partnership representative from now on. That's extremely important. It needs to be one person that the IRS can go to as a point of contact. If you do not designate a partnership representative in your operating agreement, the IRS can theoretically go to anybody in the partnership. So if you're a syndicate and you have 200 partners, the IRS could pick any one of those partners. And if you have multi-level partnerships, where not like the scam multi-level partnership, multi-level marketing, that's what I'm going for. You have multiple levels of entities. Say this one at the very top gets audited and like all these are all partnerships. Well, they could go like all the way down the line and pick somebody random down at the end. So don't let them do that. You don't want some random partner that has zero financial experience, zero tax experience to be handling your IRS matters. So make sure that you designate a partnership representative in every operating agreement.
Tax matters partner, right?
Well, you definitely need to designate a tax matters partner, but no, this is a partnership representative. It needs to be specifically called out and assigned. And it could be the same as tax matters partner. Most of our clients use the same, but it needs to be in your operating agreement, partnership representative.
Okay, so let's run through a sample acquisition. This is where I have, these are my great clients. This is forward thinking and really preemptive. They come to me prior to the purchase. They come to me prior to the deal and the money coming together. So what we're going to look at is the purchase agreement, possible cost segregation opportunities, existing leases, any vendor agreements that will carry over, deed restrictions, zoning, financing document review, loan and security agreement, and any promissory notes or personal guarantees that come with this acquisition. So, I just listed a long list of documents. My ultimate goal is that, you have somebody review each document. And, the trade-off is if you don't understand something, the other side is probably getting an advantage over you. And so what I do is I review every page. And so, whether you hire an attorney or not, what I say is read it, understand it, and then you can sign it. But if you're doing this with a new state, with a new lender, purchasing from a different entity type, all of these new structures give a little bit of wrinkle that says, well, maybe you've done this before, but unless you're purchasing the exact same entity type, the same property type from the same entity in the same state, it's going to be a little bit different, and you want to make sure you understand those ramifications. So, this is probably just pure legal. I see a lot of overlap, but what I do is, I just read it, I explain any questions that you have, and then we negotiate. Like Brandon was saying, we see a lot of deals. We know what the market is supporting, especially in our local areas. So if you want to negotiate, you want to ask for something, we are your best tool, or I'm your best tool to push through that and get that out of the other side. And that way you can structure the transaction to be exactly what you want. Oftentimes this can be a win-win situation. People talk about it, but this is where it happens. If you as a buyer want to make sure you put some protective clause of X because you care a lot about future liability from some environmental concerns, the seller, he might have owned this property for 30 years and he'll stand on his head that there are no environmental concerns. You can get a win-win where both parties are more comfortable with the property because the buyer says, great, I'm willing to pay full price because he has this warranty. Seller says, great, I get my price, and it doesn't cost the seller anything if he's willing to really stand on that. Those are little situations where if you thought it was going to be a battle or a tough negotiation, you wouldn't know until you present that opportunity.
Ron is crafty, man. We were having breakfast, lunch the other day. He flew out to Raleigh, North Carolina. So Ron's in Texas, but he flew out to Raleigh or Charlotte and then drove to Raleigh. We were having lunch and he was telling me about all these different deals that he's structured in the past and just like the different tricks that he uses to gain leverage. And I'm sitting here like writing or taking mental notes. Like I'm going to take this back to my clients because this stuff's good. So yeah. So when he's talking about like making sure that you are in the best position from a contract perspective, he's not kidding. There are some really interesting things that Ron does to make sure that you've got the best situation in front of you.
Absolutely. So yeah, then we just go down, Brandon, maybe you want to touch on cost segregation or for the real property or.
Yeah. I'll touch on, so I've really got two main points. Was CPAs, we don't really play a huge role in the acquisition phase, but we do play a role and it's a very critical role. So the first thing that we're going to do is we're going to say, do you want a cost seg study? We want to figure that out before acquisition. It's not imperative that we figure it out before acquisition, but it's nice to just have all of our ducks in a row. Further solidifies if it's in contract, if it's in writing, and it happens before that acquisition. So it just makes it a little bit better. But we have to understand if we want to take that cost seg or if we are going to elect out of the interest limitations, the new interest limitations with the 2018 tax law. You can elect to be treated as a real property trade or business and not be subject to those interest limitations. But if you do elect out, you can no longer take 100% bonus depreciation. So in the first year, the strategy that is currently on the books, but we don't know 100% since we're still waiting technical guidance from Treasury, which could be forever. But the current strategy is if I do a cost seg study in year one, I get to take 100% bonus depreciation in year one for any component that has a useful life of less than 20 years. So carpeting, land improvements like pavement, appliances, those types of things can be all written off under a cost seg study. And that can all be written off now with 100% bonus depreciation in year 1. In year 2, and then going forward, we elect out of the interest limitations. And by electing out of the interest limitations, we can no longer take 100% bonus depreciation. So if we do any sort of massive improvements, any sort of major CapEx repairs, we might be stuck depreciating them over a much longer period of time than being able to take that expense immediately. So that's what we're looking at. We're just trying to look at what is the plan, what asset class is it? If you have a class C and your rehab's going to go for 2 years, then we might not elect out of the real property trader business, or we might not elect real property trader business to elect out of the interest limitations for a period of 2 to 3 years. We also might not do the cost seg study immediately. We might wait until you get it all done and then do a cost seg study. That's what we're looking at in the acquisition phase. The other thing that we're looking at in the acquisition phase are mortgage clauses that are going to sink you. And you have to understand that the bank is always against you. They're giving you money, but they want to throw as many clauses as they can into that contract that you're signing, so that at some random point, if something happens, they can point to something and say, no, I'm going to call it because of that one clause. The specific clause that I have seen, and it's not specific, sorry, I don't have it in front of me, but the clause that I'm thinking of that most of our syndicates are facing, and we've seen a lot more of these clauses being thrown into contracts over the past 6 to 10 months. Not really sure why, but that's just what we've seen as we've been reviewing. What it says is you must provide annual certified financial statements, which seems reasonable. Okay, the bank wants financial statements, but the kicker is certified. From a CPA perspective, there's no such thing as a certified financial statement. In fact, we can't actually certify anything. There are 3 types of A-test engagements. There are audits, reviews, and compilations. Those 3 engagements are where we actually review, we perform procedures, we review the financial statements, we review the records, the work papers, everything there. And then we basically write a little letter that says, okay, we are expressing limited assurance on XYZ, and then we sign off. And if that's what the bank means, but then they throw in certified, then the question is, well, we know that they want something from a CPA, but do they want an audit? Do they want a review? Or do they want a compilation? Audits cost $15,000 to $20,000 a year. At a 10% cap rate, that's $100,000 to $200K in value. Reviews cost $7,500 roughly. Compilations $1,000 to $1,500. I would prefer to have a conversation with a lender and up front to really understand what they're asking for. Because most times they don't even need a compilation. They just want a package of financial information. But that's one of the areas that we try to really hone in on, is that the mortgage clauses that the bank is throwing in there, that your lender's throwing in there, just making sure that there's nothing weird that we're going to have to figure out after the fact. Because after the fact, we've locked into this agreement. Now we have to provide a certified financial statement. And now the question is, are we spending $20K or are we spending $1,500? And we don't want to have that conversation after we've already locked in all of our investors and locked in the property and everything like that.
Absolutely. And just to expand on that, I see a full range where the bank sometimes opens with, we're going to ask for monthly rentals, monthly P&L, monthly financial statements, cash flow, balance sheet, everything, when it's not really strictly what they need as a minimum. If you go back to them and counter propose a very reasonable monthly P&L, monthly rent roll, and then every quarter you provide the other, balance sheet and accounts receivable, aging AR quarterly. And then annually is only when you'll try to provide some larger financial statements. And the timing of that delivery can also be negotiated. I've had banks that come in and say 30 days after the end of the calendar year, you must provide a compilation. I'm saying that's insane. Nobody will be able to meet that deadline without pushing their CPA to the brink. So instead, we argue for 30 days after a tax return is submitted, or we say within 90 days at the close of the year. These are reasonable numbers that your CPA is going to look at and say, okay, I can commit to delivering a reasonable product in 90 days after the close. But the banks will put 30 just so they can have that leverage, and they don't expect you to deliver 30, but when you're late, you're in default. It gives them the leverage that if interest rates go up, they can leverage you to refinance. They can pressure you to up some other product. And, if the property is valuable, I haven't seen too many banks that are this predatory, but certainly some mezz lenders and different hard money and private equity, they would like to take the property. And then if you're in default, they will fight aggressively to try to take your property. That's just a terrible situation. So again, read the documents and understand what it means. And that's my point, Brandon. If you come across a certified financial, what is that? That was probably put in there by a lawyer who didn't know what he was talking about, but he thought it sounded good and it was an extra protection of the bank.
Yeah.
Final note on this, on personal guarantees, even for all the commercial loans, if it's anything risky or depending on the environment, you're going to be signing a principal has a personal guarantee. We do burn-offs. I have yet to see, or maybe 1 out of 30, where a bank won't agree to some form of burn-off of the personal guarantee. So these are, your high net worth individuals, people with significant assets and holdings. They're going to sign a personal guarantee for the loan amount, but that shouldn't carry for the life of the loan because the risk is not consistent. It's not a flatline risk during the life of the loan. Obviously, right after they sign it, it is low risk. After you do your renovations, it goes up. But then once those get put in place and occupancy is up, the risk of that loan defaulting drops drastically. That's where we can negotiate and say, hey, let's put a burn off. Let's put this to 50%. Let this burn off to 0 and allow this guarantor to kind of move on with their lives and pledge that collateral to new projects instead of staying locked for, say, a 5-year or a 10-year loan. If you're personally guaranteeing the balance of that loan, it's really restrictive on your ability to guarantee future loans. So it's just little things like that that it helps everyone out and it provides more liquidity. But the bank is willing to agree because even they acknowledge that the risk of default drops after X number of payments on time. So that's it. Affirmative and negative covenants. Again, depending on the level of operations, and if you have combined businesses, maybe owner financing, they're going to have some affirmative and negative covenants on the use. And that's something that we just have to negotiate because they're going to put things like no vice or sinful uses. And then you say, well, what if can I lease this out to a vaping store? Can I do medical marijuana? You might think as a landlord, yeah, that's fine. That's a licensed, regulated use. Lender is going to say no. That's not federally recognized, and we want to sell this, securitize this loan. We can't have an income stream that is not blessed by the federal government. So you have these little conflicts, and again, that goes back to the investor interview. I'm going to find out what your intended tenants are. I'm going to find out if you're looking for this group of uses. So finally, post-acquisition operations. This is probably, again, heavy lifting on our side, maybe once a year from your accountant. But once you have everything set in place, you have that relationship with your attorney. We're going to look at leases. We're going to negotiate with all the TI, the tenant improvement, the build out, any tenant requirements and their building code. If you have a property manager, if you're carrying over the existing or if you're going to sign a new agreement, making sure that you understand what the scope of their responsibilities are. If you're going to give them any kind of bonus of occupancy or performance of revenue at the end of the year, vendor service agreements. A lot of people buying these buildings just ask for the book of everybody who has been servicing the elevators, who's been doing the landscaping, who's doing the concrete, the plumbing, the electrical, the roofing. Are you going to take them at face value and just roll over all the vendors? Some people do, and some people don't. That's going to be up to you, but there are opportunities to save money by seeking out new relationships or even just renegotiating the terms of your existing. Say, hey, I'm a new owner. You've had price increases the last 10 years, but I just put in a brand new elevator. I want to renegotiate the service call fee. I want to renegotiate some of this. It's all available. Contractors, marketing, who are your brokers going to be? Who's going to lease this up? How are you going to pay commissions for for maybe apartments. Allocation and characterization of expenses, that's something back to the CPA. But if you have some expense that is maybe borderline expense or capital improvement, we can structure in the contract to phrase it as much more of a one-time upfront cost as opposed to maybe a future payment, Brandon, or like a future purchase that is not expensed until the service is performed. Something like that, you can control your income and say, I'm going to prepay for 5 years of service and prepay now, take that expense full in this year, and then I know that I have this service company to come out and provide service. So again, it really just depends on how you want to structure your income. But most people say, I want to take as many expenses up front as I can and have that stored asset value in the future. You have a lot of room with these types of service contracts. And then finally, I'll go to the sale. Brandon, you mentioned 1031, or what do you want to do as a seller? You've purchased this property, you've improved it, you've collected income, now you want to sell it.
Yeah, I've actually got a couple notes on the operation. So our firm plays a pretty big role with the syndicates and the larger funds in terms of helping them operate. And the things that we are primarily doing is servicing you via accounting services. So one of the things that we've tried to explain to everybody is if you don't have up-to-date, accurate records, your investors are not going to be happy. You're not going to know how you're performing, and we're not going to be able to help you with the tax strategy anyway. So we would love to be able to look at accurate, up-to-date financial records and then be able to help you navigate the business interest limitations. That do we elect out or do we not? Do we invest in rehab, invest in CapEx now, elect out later, or do we elect out now and never invest in CapEx because we've already done it all up front? That's what the accurate data is going to show us how to do. Ron talked about front loading expenses. We have a lot of advice that we can provide along those lines. It goes back to the goals. What are the goals here? What are you trying to accomplish? If we're trying to maximize net operating income for a 5 to 7 year sale, or a 5 to 7 year hold and selling at the end of that hold period, well, we need to know that, because it's all about how do we structure the expenses up front in a way that is kosher with the IRS and also maximizes your exit price. Those are the things that we can help you with. But we've been on this almost like a marketing campaign. Like, it starts with your accounting. If you don't have good accounting, we can't do anything. We can't do anything at all. So I would highly recommend that everybody get their accounting in order. Make sure that you can provide, if I can log into your accounting system and see today up to date, you're solid. If I can't do that, you might not be solid and you might need to take a second look. But once you get your accounting in order, you engage a CPA for tax strategy. Ask them, hey, there's some things that affect syndicates, affect funds. What do I need to know to maximize my investor returns? Hey, I need help managing my cash flow. I need help budgeting. Those are CFO services. Can you provide those services for me? Or do I need to go pay a $200,000 CFO every year to provide that service for me? So those are the things that your CPA firm can step in and provide for you as you are operating the property and kind of moving along. But we do a lot with just, okay, we've got this CapEx that's coming in. How do we want to classify that from a tax perspective, from an accounting perspective, from a net operating income perspective? What are we doing to maximize net operating income, or are we trying to minimize net operating income and minimize taxes? There's a lot of different things that we're constantly touching base with our clients that are in this space, just making sure that we're all on the same page. The last point that I'll make here with the operation is the annual tax filings. So annual tax filings for most entities are due 3/15. Now, if you are a syndicate, or if you're a general partner, or you're a fund owner, you know that your investors, or if you have prior experience, you know that investors get really, really antsy right around February, March. They want that K1, right? And you are stressed, especially if you've got 200 investors that you're trying to send K1s to. So if you do like an all in-house service with your CPA, where they do all of your accounting, they do all of your tax strategy, they do your CFO work, they should be able to get that information out to your investors relatively quickly. And then you only have to deal with like the ones that, want to file at the end of January, which I think those guys are always nuts, but, but that's just one benefit. So just think about that too. It's not even just purely a financial or accounting strategy. It's my investor relations strategy too. I need to make sure that I'm partnering with a good CPA who, if they do this stuff, they can either provide the new CPA or my tax CPA with the information very quickly, or they can get or this CPA, I'm going to go all in with them and they can get all this stuff out by, end of February, something like that.
Yeah, just to piggyback on that comment, there is real value in being responsive to buyers or brokers or lenders' requests. So if you're on this call and I say, show me all your existing leases, do you have a copy of your current leases plus amendments plus tenant information, and relatively current, or when was the last time you updated their driver's license, and you have phone numbers for all your tenants? If you have that information, or maybe your property manager does, but have you ever asked for it? If you have that, great. I don't need to see a copy. But for my clients that they own one or two properties, they're not as organized. They don't have an in-house attorney or a legal department to run those documents. So the question is, if you can provide all of those promptly and they're organized, you're going to get better value, because the buyers are going to know that you're on top of this. You're on top of expenses. You treat legal and accounting as important. I don't know, what do we do, Brandon? We're about what, 10% of operations plus or minus. So if you add 10% value in legal and 10% in value on accounting, you're up 20. That's a lot of return for most deals. So
yeah,
just having those organized, and I know people too that buy disorganized mom and pops, purely slap professional branding on the pitch book, clean up their legal, clean up the accounting, present nice financials, and then they can make a spread. The cap rate drops like 2 points. So there's much to be said. And if you guys are listening and you're already optimized, and you can say, yes, Brandon, you're welcome into my accounting system anytime. It's clean. And you say, Ron, I got all my contracts. I have them color coordinated in tabbed binders. Then I'm saying, great, good for you. That's something we don't have to provide. But if you're not there, try to think about it and how it can improve your headaches and sale value on exit.
Absolutely. All right, let's move on to sale. We've got a couple minutes here, which is good because I don't have a lot to say on this other than for CPAs, for your CPA partner, planning for the sale is at least 18 months out from the sale, unless you get some wild sales offer or whatever. That's fine. We can just pivot. But don't surprise us with the fact that you want to sell. Let us know a good 18 months out, because again, we want to structure net operating income to maximize the value, right? We want to understand what are the exit opportunities that we should be exploring. Should we explore a 1031 exchange? Do the LPs want to stay in the deal? Limited partners, they want to stay in the deal? Or if it's just you and one other partner, do you guys want to continue partnering together? Does a 1031 make sense? Does it not make sense? What sort of things how do we need to be treating repairs, CapEx? That's what we're doing sales wise. And then it's just reporting, right? It's just reporting. So we can run analysis for you. We can run scenarios for you to show you what a sale looks like. If we don't go a 1031 exchange route, then it's just reporting the sale. If we do go the 1031 exchange route, then it's still reporting the sale, but we run a couple more gimmicks on the tax return. So we don't play a huge role in the liquidation aside from, about 12 to 18 months out. We want to make sure that we're talking at that time to truly understand what the expectation is going to be whenever that sale occurs. And again, a lot of it's investor relations. You got to go back to your investors and say, hey, we're going to liquidate. Here's what's going to happen per the CPA that we're working with. Here's what you can expect in terms of taxable income coming to you, or something along those lines.
Yeah, and again, I think for the attorney, we're maybe a little bit more involved on the sale. Come to us to make sure if you have any early termination penalties of your contracts, or if you can carry those over. Work with the listing broker if you're going to use a commercial broker, or maybe for sale by owner. Make sure you understand what that agreement is. make sure you understand how long their period is, because a lot of lawsuits happen when you hire a broker for 6 months, he doesn't sell the property, you think you've terminated it, you hire somebody else, they bring that broker, but they've had a 3-month tail after the termination of their representation agreement, things like that, and then they'll sue and they have a legitimate paper claim. And again, people would understand it if they read it, but more often it happens. And so it can be kind of frustrating for a seller, especially when they're flush with cash, to have this nuisance lawsuit. And then again, your lawyer is going to be providing all the documents to the buyer. It's usually a package. So once we package everything up, maybe have a data room, again, depending on how big the portfolio is, we'll assemble that into a data room and then just share that with all the buyers. But negotiation with the buyer, we're pretty involved. Just depends on what you want. Do you want to maximize the sales price at all other costs? And that might mean extending the closing to ensure that the buyer has a holdback, or they want to wait and see some other numbers or metrics hit. Do you want cash offers? Cash is pretty strong, but you might be taking a little bit of discount, but you probably get the fastest close and the highest certainty of closing. They can waive certain contingencies. So again, talk and think about what suits your investors back. You might have a 7-year period or a 5-year period on your LPs. You're at year 4.5. You probably need a certain sale just to make sure you return the funds on time. Little things like that to make sure everything complies with your original limited partnership agreements, your subscription docs, and your offering memorandum, all that. So open up for questions.
Yes, we have 6 questions. Everybody take a breather, take a drink of water. I know I've been slurping on some water over here. Get some questions in for us. We've got 6 right now. We'll start at the top. And Ron, do you have the Q&A button pulled up and everything? That screen?
Yep, I got it.
Cool. All right, so I'll start at the top one here. So what is a reasonable or typical split for an LP investor who's totally passive, assumes no liability or risk, debt structure, e.g., puts up 50% of the down payment or purchase price, doesn't do anything else? I'm not going to answer at what point do you need to deal with the SEC. That's a wrong question. But the split itself, it largely depends. So in these big syndicates, the GP, the people, the general partners, the ones that are doing everything, they only take 30% in most cases. It might be 33, 35, it might be 25, depending on the experience and who's making up that GP team. But in the smaller partnerships, I oftentimes see 40, 60, 50, 50. It really just depends on what you're able to strike with the GP in your particular deal. But those syndicates are the ones that I would kind of, it depends on the size too, but the larger ones, I would expect the LPs to have right around 70%, even though they're doing nothing but putting up the capital.
And then at what point do you need to deal with the SEC? So there's a variety of regulations. I'll say that this does not apply to anybody on this call. I'm not your attorney. I haven't seen your individual facts, but roughly you need to think about the SEC when you're offering or doing solicitation. So if I just go up to Brandon right now and say, hey, I have a deal. Do you want to invest with me as a partner? We'll share the risks 70-30 and you just put in capital. That's not a general solicitation. That's not a offering, so to speak, that he could give to other people. It's a unique one-on-one tailoring just for him. You need to deal with the SEC when you're beyond reaching out to specific people. And that's what we talk about. We handle a lot of these Reg D, Reg S, 503A. There's exemptions that you can do it for accredited investors. Maybe under the Jobs Act, crowdfunding, a lot of different things. And we handle that. But if you have a deal like that, then feel free to reach out, run the numbers by me, and see if it makes sense for the amount of capital you want to raise.
Good stuff. Moving on to the next one. Is there a rule of thumb to determine the amount of leverage a bank will allow on mortgages? I've seen 70% is typical, 70% loan to value. Typically our larger syndicates, they won't necessarily raise the 30%, but they'll get more financing on top of that original 70% financing. but it is all about relationships and the size of your operations. And we've seen syndicates who start with only getting 70% and then they move into 80%, 85%. So it really just depends on what's the track record of the company that you're building. And then what do those relationships look like that you're building out? What do you think, Ron? What have you seen?
Yeah, if it's your second or third deal and you've had good performing debt, that's going to be your strongest track record to push anything beyond 70, 75. I mean, maybe in this market, if you have a home run acquisition with really strong personal guarantors, you might be able to get up to 80, but anything in the 70 is 70 to 80 is going to be normal. 60 to 65 for new construction.
Good stuff. Are these burnouts of personal guarantees and or certified financials from Fannie, Freddie, or from regional local banks? Ron?
Both. I haven't seen many deals. It has to be a portfolio or a really strong cash flow record for non-recourse debt. They all have either for Fannie and Freddie, they're going to have bad boy carve-outs. So you can have non-recourse there, but you're going to have to involve an individual that's going to be vetted as a part of pretty much every loan.
Tenant improvements. Any thought on how to determine what is reasonable? Do you see an industry average? You want to take a stab at this?
Depends on the industry. Depends if you're doing, retail, restaurant, or you're doing.
That's why I wanted you to take a stab at it. I was like, you go first. That was rude of me. I'm the host. I should totally not have done that, but.
Age of the building. The answer is no. It's all local market driven. And in those cases too, I would even recommend talk to your broker. The broker sees not necessarily more deals. They do see a lot of deals, but they also see more asks and rejections. And that's what I don't see. I don't see the asks that are at 50 a foot and 30 a foot, and then they settle on 20. I don't know if that was tenant starting low or landlord coming down. So,
what good is a promissory note or personal guarantee in personal or LLC bankruptcy on a rental property?
That's a whole separate obligation to pay. And I would say it's absolutely good because you are personally guaranteeing a secondary charge against this, a separate entity. So I would think of them as parallel routes to recover the funds. It's not that you're extinguishing that right to collect a personal guarantee on rental property, but it's a secondary additional obligation. They're very powerful. I mean, people will sue on these and collect all the time.
All right, we've got Ron. I have many 5-year leases. How do I become the first in line?
Just give me a call. Yeah.
Actually, Ron, if you don't mind, I think everybody here has my contact information. But if you don't mind just chatting to everybody real quick, your phone number and email, or just your email if you prefer people to contact you that way, that'll be good.
Sure.
All right, while he's doing that, I will take a stab at the next one. Can I perform a simple cost segregation study myself? Do you have any examples of a cost segregation study that you could share? So we do have examples of cost seg studies. We can't share them with everybody, so you can contact me or the team since I know who you are afterwards. Can you perform a cost segregation study yourself? Yes, you can perform a simple cost seg study yourself. So you could basically go through and get the model number of your appliances. You could get the square footage of your carpet, and you could structure a small cost seg study by using like eBay, for instance, as ways to price out what you could sell the property for today. But here's the kicker. Then you have to create a formula that takes you back in time, that basically converts today's price to back in time dollars. And that's where it might get a little challenging, but we can help you with all that. Or at least we can help you kind of explain the concept. But yeah, you can totally perform a simple cost seg study yourself. You're not going to be able to say, well, 10% of the electricity is classified as personal property because you don't have that experience. You're not going to be able to say 10% of the plumbing should be classified as personal property because, again, there's no engineering experience. There's no financial experience. Actually, you might have both. I have no idea. But if you do, go for it. If not, stick to the simple things like the appliances, the carpeting, things that you can measure, things that you can easily find online, and you can perform your own small cost seg study. All right. Can you briefly explain in the capital stack how you structure mezzanine finance? You want to take a stab at that one, Ron?
Sure. I mean, typically where we see mezz is, after the senior and you have a large senior debt position, and basically the bank is saying, this is what we feel, you definitely underwrite, but we don't want more exposure in this bucket. So they kind of cap what they have in terms of that bucket. And you'll bring in a mezz lender at a pretty high interest rate, come in as debt or convertible or some type of equity. And they'll come in at a high interest rate and just really provide that liquidity as a cushion or as a little hump to be a really competitive offer. And, it's got to be a home run of a deal that says the bank will only appraise this, say, for $100 million. They're only going to lend us $65 million. We have equity in it at 30, but that doesn't get us there if we need to pay over 100. And we really underwrite it as being a home run deal. Some mezz guy will come in and say, okay, you need 5, you need 10, 15 million. I'll come in, but it will be lucrative rates. That's almost all upside. I see a lot of analogies between that and kind of a hard money lender on the single family side.
Yeah.
You can make those deals work, but you got to be really sure of the numbers and the exit in order to justify paying that high price.
Our clients that use mezz financing are generally within 6 months trying to figure out how to get out. Multiple conversations are had between us and them on me and the client. On, okay, we've got this mezz financing now. How do we get out of this before we're converting to equity or just eliminating or limiting that interest? All right. I have an S corp from years ago. Sole owner. Want to do a 1031. Do I have to keep the same S corp, or can I start a new entity like an LLC? Complicated question. The safe answer is the taxpayer must remain the same. So yes, you need to have the same S corporation. There are more complicated answers that require more structuring. If you would like to learn more, feel free to contact us. But that's where I'm going to leave that one. Unless you have anything else to say on that.
No.
Okay. All right. Can you talk a little bit more about the burn off out clause, how to request it? What is it specifically based upon to substantiate your request with the lender?
Yeah, I think we just include it in our edits and our markup of the initial loan documents. Usually the personal guarantee is separate. It has a duration clause. It has specific triggers that we'll just write in paragraphs on what they're looking for. And there's not a specific letter or anything, but you just send it and include it as part of your write-ups, your edits back to the lender.
All right. Last question. Outside of fraud, gross negligence, for very small owners who prefer a single member LLC for simpler tax filing, is my corporate veil more easily pierced? Sorry, I'm a tax guy, not a English guy. Is my corporate veil more easily pierced than other multi-member partnership filers who file partnership returns because I'm a disregarded entity?
The legal answer is no. On its face, they provide absolutely the same legal protection. In reality, it's going to come down to your practices and how you run the business, because are you running separate EINs? Does that lead to separate bank accounts? What are the number of transactions where you're expensing back to yourself? I think that as a practical matter, if you have a partnership and you have somebody else even to kind of keep you accountable to not commingle funds, to not sign emails, or God forbid you sign a contract as that, you're going to have more points of evidence to negate piercing the veil if you have it structured as a partnership. And again, legally, no. The standards of law and the burdens are all identical. You have the same protection. In reality, what the courts are going to be looking for is a factual analysis. They're going to be looking for points of evidence that lead one way or the other. And if you have a partnership, maybe there's less opportunity to make a mistake. But
yeah, and we try to help our clients understand how to operate just a regular business when you have an LLC. Because to kind of echo what Ron was saying, that's what we see where people mess up. And none of our clients have been like sued over anything like this or anything. But we do see when people have a single member LLC, they don't have a partner to hold themselves accountable. They don't have investors to hold themselves accountable. So they tend to kind of fly by the seat of their pants when it comes to operating the business. And that goes all the way down to the accounting records and the tax records. So just make sure that you are operating as a business, even though it's a single member LLC and there's no separate tax reporting. You do want to make sure that you are treating it as a separate business. But that's all we have time for, guys. So thanks a ton for joining us. Ron, where can everybody find you?
On the internet or on the chat, I put out my email. Feel free to visit the website, PAMLaw, PAMLAW.com. It's got all of our attorneys. We do a lot of international work. I deal with foreign investors every week. So feel free to reach out on the website, and email is really the best way to get a hold of me, and feel free to schedule a call, and I'm happy to chat.
Great stuff. And you guys can contact me at contact@therealestatecpa.com, or just go to www.therealestatecpa.com. But I think that the majority of you are on our newsletter, so it shouldn't be an issue. Well, thanks a ton, Ron. We appreciate your time. I hope everybody found some value out of this, and send me an email with your thoughts. Like if you have any sort of feedback that you'd like to give, let me know. We're testing out different webinar ideas here. So we want to know, like, is this dual panelist thing a good idea? Should we just have a guest speaker? Just let Ron talk for 60 minutes. What do you guys want to hear? What do you want to know more about? Let us know. It'll give us some ideas, and it'll allow us to bring you higher value webinars. But thanks a ton, everybody. Hope you have a good rest of your day.